You focus on flexibility and liquidity. Is that because you want to move on a dime in response to some of these data points?
It's because we think there are a huge number of opportunities out there, particularly in fixed income right now. You can lock in very, very attractive all-in yields, very attractive carry with very good liquidity and limited duration risk. But that being said, it's a very uncertain time in terms of the Fed. We do think they may start to cut rates at some point this year, but it's too early right now, we think, to tell exactly when. Likewise, we do have, obviously the ECB, we think are very likely to cut rates tomorrow, and then they're most likely to be data dependent as well. Bank of England may cut rates at some point in the near future, and again, will be very data dependent. And I think, as you say, a lot of the data is becoming sort of, as you say, quite messy. And as we do see this normalization and two-way risk coming in a lot of the data, whether it's the labor market, whether it's other economic activity such as manufacturing, consumption, retail sales, you name it. And so we do think it's important that we are flexible, that we can actually deploy money where we think we see the best opportunities. We want to lock in the best income that we can for clients, but we also want to protect against outside events. And as you say, we don't know a catalyst for the data to really swing dramatically one way or the other, but we want to be prepared, and we think that's very, very prudent at this stage in managing the portfolio. We want to be very, very risk aware, and we really want to understand exactly where the risks are in each position that we have, and be aware that we can change portfolios if we think necessary.
Talk to us about how to confront this negative yield curve, this inverted yield curve, 2-year, 10-year, negative 45 basis points. You're talking about normalization. You're not talking about deterioration. You're talking about 1 or 2 rate cuts. We're not talking about deep rate cutting cycles. So what is the argument for people out there who are looking at a 2-year that gives me 480 and a 10-year that offers 432? Why would I extend duration, go out along the curve? What's the reason for that?
So I think certainly in the US and in the Treasury market, it's hard to really give a good reason why you would go out the curve, particularly sort of between 10 and 30 years. It's hard to see a good rationale for taking that duration risk, as you say, when you can get better carry at the front end. And particularly, as say, for the front end, if we do start to maybe hear a little bit more from the Fed, maybe potentially to cut rates potentially this year, then you could see a little bit of a shift down in yields in the front end in particular. But as I say, the curve is very inverted, and it's hard to see yet a reason for taking duration further out the curve then. That being said, when you look at investment grade, when you look at other areas of the global bond market, then we think it does make sense to take a bit more duration risk. So, for example, in the UK, we're overweight duration. In areas of the Eurozone, IG corporates, we have added a little bit more duration risk there as well. But I think it's about being very, very tactical and very specific about where you choose to take that duration risk. We certainly think that rates will remain higher than the market expected and higher than they have been for a long time. So even as the Fed does start to cut and as the ECB starts to cut, we think it's going to be very, very gradual. And as you know, there's been a huge debate around where our star is. We need to see inflation come down in a sustainable way towards the various central banks' targets, and it's not there yet in most cases. And so we do think that rates will remain higher than they have been for quite some time, and certainly higher than has been expected both by the central banks themselves, whether it's the summary of economic projections or other things as well, then maybe and also certainly than the market had been anticipated.